Hello and a very good evening to everybody who's present. Today's session is a collaborative effort between IIN and the IIM Alumni Association in Singapore. For those who already don't know about this, IIN has entered into a strategic alliance with the IIM Alumni Association Singapore to open new doors in the India-Singapore startup corridor. So this partnership is primarily based on it's twofold, right? I mean, it's to support the IIM alumni-based startups in Singapore that are disrupting the ecosystem there. And at the same time, the investors in Singapore who are keen to assess startups in their growth journey in India. So we want to give them a platform through IIN, right? Now, we do have both the IIM Alumni Association and IIN members on the call with us today. From the IIM Expo representatives, I would like to just mention that we have Mr. Anand, Ashok, Sengupta, and Ravish Kumar with us. So very warm welcome to all three of you. So we've begun with this series to cover various topics under angel investment, right? With the first session that was held on a basic overview of angel investment and introduction. Today's topic is more to deep dive into how do we discover valuable startups, how do we evaluate these pitches, and what do the valuations look like for these kind of companies, right? So for this, we have with us a very esteemed IIN member and a prominent name in the startup ecosystem, Mr. KRS Jamwal. A seasoned leader and IIMA alumni himself, Mr. Jamwal has had a stellar 35-year stint with the Tata Group. His past tenure alongside industry leaders, especially when he was working with Mr. Ratan Tata, shaped his strategic and technology orientation. As the executive director and CEO of Tata Industries for 14 years, he ideated and incubated transformative projects, including Tata Clean, Tata Smart Foods, and Tata Class Edge. And he's also led and managed over 10 different businesses in this period. In his personal capacity, to throw some more light on his startup journey, he has invested in 110 predominantly Indian startups, and luckily for us, more than half via IIM. So as we start the session, I would request the audience to share your questions in the Q&A section as we go along, and we will take them up in the course of the session, right? So without further ado, I would like to invite Mr. Jamwal to take over. Mr. Jamwal, very, very warm welcome to you, and thank you for joining us today. I'll let you take the stage now from here.
Thank you, Smriti. Is my voice coming across clearly?
Yes.
Okay, great. I see lots of friends in the attendance list. So thank you everybody who joined. And Smriti, thank you for that glowing introduction. I always find it hard not to feel a little embarrassed when I get introduced. But you know, coming to the main topic of this conversation. I think you suggested that I lead off with how have I gone about discovery and evaluation of startups and what has worked for me. A little bit of context here. I actually started looking at startups because in my day job in scanning for new technologies that would be worthwhile businesses for the Tata Group, I was scanning the Silicon Valley, the Boston, the UK, and the Israeli ecosystems. And I still remember somebody I used as a sounding board in those days said, but what about Indian startups and Indian technology efforts? And I said, well, I looked at it closely in the 2008 to 2012 timeframe. And I found that in most technology areas, deep tech areas, we were nowhere near cutting edge. And it will probably take us, I said at that time, it will probably take us 10, 12, 15 years to begin to develop any sensible cohort of cutting edge, global first deep tech startups. And two things that stayed in my mind from that questioning and that conversation I had was, one is startups and business ideas need not necessarily always be deep tech. There could be a whole host of consumer tech and other technology areas. And I myself was interested in platforms, both e-commerce and other platforms that would proliferate. And secondly, I realized that it was a gap in my knowledge in terms of actually doing the startup scanning. So in the 12-13 time frame, I actually, as Tata Industries, we took membership of a couple of places like Mumbai Angels and KRS Forum. Again, I found that passive investing, because Tata Industries being a NBFC CIC is not allowed to take minority stakes. That passive sort of window shopping did not work for me. One did not internalize either the strength or the weaknesses of the startup. So by around a year or two after that, I actually decided that, okay, in my personal capacity, I would start investing as an angel, because only then would I really get a granular understanding of what that startup is likely to become. And since I wasn't jumping into this from the idea that it will make a huge positive in my net worth, I actually followed a very sort of getting the theory right kind of approach. I spoke to lots of people. I spoke to some of my VC friends. I spoke to some of my private equity friends. And the one thing they stressed was, as opposed to private equity, where the failure rate is likely to be only 20%, in VC, one should expect a failure rate of 80%. And therefore, the two things they stressed to me were one, look at investing in a large number of startups. And the number I heard most often was 50 to 100. They said, look, if you're going into angel investing, plan and budget for between 50 to 100 startups. It could be over 4 or 5 years, but that should be your portfolio at the end of your phase one of your startup investing, or the amount you want to put in. And the second was, they said, try and ensure that there is always convexity in every startup that you invest in. That convexity bit is especially important. By convexity, I mean the likelihood. There's never a certainty, but the likelihood that you'll get a 50x or a 100x return. In both cases, they pointed to me the dangers of violating that rule. These are both necessary conditions. They're not still not sufficient conditions. They're both necessary conditions. Violating the rule one, which is less than 50 startups, could probably mean that you may not even have the 1 or 2 or 3 hits of 50x, 100x that you needed to return your portfolio, get returns on your portfolio. Violation of the second rule of lack of convexity was that if you invest in all the startups which are supposedly safe at a 10x, in reality, the death rate is going to be the same. And what will happen is, instead of the 5-10 startups out of your portfolio that become 50x, you'll get 5-10 startups which become 10x, which means you again may not get your money back. So these were the two conditions. Based on these, I started looking at what would give me adequate deal flow, and I realized that depending on personal connections alone, or doing a when a startup comes to me, or when I notice a startup, or when my personal network gives a startup to me, was very uncertain, and I needed that volume so that in 5 years I could cover 50 to 100 startups. And therefore, with that cold start problem, because as an individual you have a cold start problem, you will never have that network or that credibility as an angel to have people coming to you. I looked at which of the angel networks I wanted to participate in, and yes, my evaluation threw up IN as well. 3 or 4 reasons for my choice of IN. One is, of course, it's the oldest network, so it had the longest track record. I actually did not go on theoretical numbers of returns. Many networks or many VCs publish returns of different funds. Networks talk about returns. Frankly, everybody talks about 20% plus. So there's very little to choose from in terms of returns from networks. I looked at actually 4 factors. Longevity was one, IN being around for a long time. Volume was the second. I wanted to a network which had a volume of anywhere between 30 to 40 investment opportunities a year. I may only do 10 or 15 out of those, but I wanted that deal flow. So volume was the second. I did talk to a lot of people and get word of mouth on quality, because the other thing that can upset all calculations of returns from angel investing is quality of deal flow. So I did check on word of mouth on quality. And lastly, and actually the most important, was I looked closely at incentives or the orientation of that network. And this is a point that I will emphasize, because there are some networks that do a hard sell. And maybe their incentives are oriented that way, or maybe their sort of DNA is that way. But to me, that hard sell or FOMO approach actually amounts to close to mis-selling an opportunity, because even the most attractive startup has the same failure rate as the remaining 50 or 100 startups. So to me, the incentives, and I found IN incentives were very oriented towards volumes and quality, but not on getting the maximum number of people to invest each time. And that's those who've actually been part of IN realize that the format of having members as leads usually ensures that the members take a slightly more judicious approach to recommending a startup than to overselling it, because they're not incentivized to sort of make value out of each deal. Having said that, after IN, I also added to my deal flow two other networks, especially a decent volume from 100x, because I think they approach startups at a different phase of the journey. In fact, many of their startups are pre-revenue. So I added 100x, and Sanjay Mehta is a former IN member who set up 100x. Very interesting that they're sort of almost an incubator, accelerator, come network sort of approach. And I'm also a member of Venture Catalysts. Over time, my direct deal volume has also increased to the extent where now I would say almost anywhere between 10 to 20% of my portfolio is direct deals. For some reason, the direct deals quality is quite high. Maybe because when people refer direct deals to you, they are cognizant of the reputation aspect of recommending a direct deal to you. Having said that, I do have one defense mechanism, and wherever I've not followed it, I have suffered. I do direct investments only where there is already a VC or some institutional investor in the round. The times I have not done that have been one or two cases where the outcomes have not been good. So direct deals have that risk that you have to do diligence yourself if there's not a institutional investment around, or you have to know the person personally and trust the person a lot. And that's another reason why I like networks, because all the heavy lifting in terms of due diligence, filings, documentation, all of that is done by the network. So lots of benefits for the network, and that's why I would continue to invest. Maybe 80% of my angel investments will continue to be via IN or equally good networks that I'm part of. So with that sort of initial thought process, we can either stop for questions, Q&A here, or I can directly jump on into what you wanted me to cover in the second part, which is how do you assess valuations of startups? Do we want to see any questions or raise of hands at this stage?
I think, Mr. Jamwal, we could probably complete the three, topics that we have, and then we can. I mean, the audience is free to please put up questions, and we can take them in the due course of time.
Okay. The only thing is with this format, I won't be able to see the people or hear them speak. But I guess that's part of the format, I guess. Okay. In terms of the second aspect that you wanted me to cover, it was about how do you assess valuations of the startups, and are there any particular methods used by angels to estimate valuation? So here's the thing. In a private equity sort of form of investing, yes, you can do DCF to provide some kind of anchor. I don't think in angel investment and early stage investments, DCF makes much sense to me, at least. It ends up just being a Excel sort of mathematics. I do look for startups to present their plan for the next year or two in terms of revenues and costs, but that's more to check whether they have an understanding of where that revenue is going to come from, what are the key drivers of that revenue, and what are the key cost elements, what are the unit economics. The purpose of getting startups to put their financial plans, in my case, is not so much to derive valuation from them, but to make sure that they have a financial plan and to check their unit economics. So when it's pre-revenue or early revenue, it's not really worthwhile doing DCF in my view. I find a simple framework or an approximation is much better. When you're going to make your money by that small percentage of 10 or 20% of your portfolio that are going to be winners, firstly, I would say that I personally do not overemphasize on entry value, because for those startups which are going to give you 50x, which means that you're going to exit at a valuation of, let's say, 1,000 crores. Whether you entered at 10 or 12 crores as pre-money is not going to make that much of a difference. What may make a difference, yes, if you're 10 versus 20 can make a big difference, but 10, 12, so I don't overbrain that valuation to the last rupee or dollar. What I do look at is what value am I likely to get downstream? And that's the only real way that I have an anchor in terms of valuing the startup. Let me give you the example of SaaS companies. The reason why we readily value SaaS companies at, let's say, and this is a range depending on what we think are the growth prospects, what is the share of enterprise business, what is the share of foreign or US businesses in SaaS companies. But the reason why I would readily value a Indian enterprise SaaS business at, let's say, 10x is because I can look downstream and say listed SaaS is at 5x revenue. Given the rapid growth rate of that I see this SaaS company going through in the early years, I'm comfortable giving 10x because I can do the math and say, okay, by the time this 500,000 ARR SaaS reaches 10 million ARR SaaS and reduces to 5 times revenue, I'm confident that my valuation will be very sensible. So at 500,000 revenue, if I'm giving 10x, I'm basically valuing it at 5 million. And I know that in a series A or B itself, it may get 7 to 8 times revenue, by which time it is, let's say, 2 million. And 7 to 8 into 2 million will be anywhere from 15 million or so. The chance of a down round or a flat round is very low because I'm entering at a 5 million pre-money. And within a couple of rounds thereafter, it should be at a 15 million pre-money. I find that's the only way I can. So these rough approximations is the only way I can get a sense of value and make sure that at least I'm not overpaying or I'm not likely to get I'm not like to have too many startups where I'm destroying value by paying too much at the beginning. In fact, the biggest destroyer of value, in my view, for an early stage investor is when the immediate next round is either flat or a down round. So that's why, to me, looking 1 or 2 rounds down the line and saying, what are they likely to be able to raise in their A round is very important to me. I think I've spoken for the last 20 minutes. So let's keep the rest of the 20-25 minutes for Q&A, and we don't have to use up the entire 1 hour also, Smith.
Sure. So I have a couple of questions, Mr. Jamwal, and I think you provided very insightful logics to the valuation part and how you evaluate these pitches, right? Especially when you mentioned about how you started with your journey of angel investment. A couple of questions on the valuation side of things, right? And I would again request the audience to please keep putting your questions, and we'll take it from there. But a couple of questions from my end. How do you value deep tech startups? So, of course, sector to sector, the valuation or the process would change, right? So, especially for deep tech startups, what is your thesis or how do you value such startups?
That's a very good question. And, deep tech is even harder than SaaS, if you ask me, and even more fuzzy. With deep tech startups, the only way I see of valuing them is to look at, if you can. So here's the thing: in molecules, and I'm talking about pharma or pharma related, where you're talking about molecule IP. Fortunately, there are benchmarks of transactions and values for molecules in certain fields. In sort of what's called, if a molecule has crossed phase 1, if it's crossed phase 2, things like that. So there are benchmarks there, but in a space tech startup, for example, it's literally what's the size of the addressable market that the startup is going after, how much capital the startup is going to need, and estimating that after all that dilution, because the capital needs are going to be much higher. After all that dilution, if the startup succeeds, are you getting in at a sensible price? But are there benchmarks for those? I have not found any sensible benchmarks, usually because the areas are so different.
Right.
The areas are so different. My Israeli friends have a very simple system, actually. And especially one of my good friends who's a super angel in Israel, he actually says, what do these guys need for the next 2 years? And that is pure deep tech. What do these guys need for the next 2 years? And he says 20% to 30% is the dilution they should get for the money they need for the next 2 years. And with that 20 to 30% for the amount that they need. So typically, let's say the startup needs 2 to 3 million for the next 2 years. In a deep tech startup, the spends are often larger. He will then value that startup at 10 million if it's 2 to 3 years, because that's the dilution it will take. But remember, he's doing it when he's fairly clear that the startup by a D or a E round is going to be worth anything from 150 to 200 million and has the potential to be a billion unicorn. So in his case, what he says is he doesn't do Excel sheets and that. He says a startup at an early stage should not be diluting more than 20 to 30% for the first 2 years. I will put in the money for the first 2 years. And I will take that value so that the dilution is only 20 to 30%. If the startup needs only $1 million, great. if the startup is in a space that is humongous, maybe they'll still get that 10 or 20 million valuation at an early stage, despite needing only a million or 2 million.
Right.
But no, deep tech, I have not found any very rational way to value real, true deep tech or deep science startups. If somebody has thoughts on that, I'd be very happy to enter into a discussion and actually learn more about that.
Sure, sure. I think one of the questions have also come up on similar question, but on drug discovery startups. So I think a fellow IN member, I think Mr. Punekar has asked this question about how would you value drug discovery startups, for example, Ahamu, which is part of the IN's portfolio. So I think some of that you've already covered, but if you'd like to add more to this.
You know, drug discovery startups, if it's a global drug, then there are benchmarks depending on the indication, depending on the size of the market that drug or that therapy is targeting. There are benchmarks, and I have friends who are who've either started up 2 or 3 companies in that, or who have invested a lot in that. Those benchmarks are not hard to find, because you know what typically happens in a drug discovery is you get bids. If your candidate is of interest to the big pharma, you will get bids the moment in some cases, the moment you cross phase 1. In my official avatar, I have licensed molecules even in preclinical. But you know, it's best to follow those benchmarks based on. I would even go to consultants if the addressable market is large enough. I would even talk to some pharma consultant, which in my official capacity I have used in the past, to assess whether we are being given the right value. But typically our deals have been licensing deals, not investment deals, because we own those molecules. So we out-license them to US startups. But preclinical, anywhere between 5 million to 20 million is possible. Post phase 1, anywhere between 20 million to 50 million. If you're in a blockbuster area, of course, could be higher. But post phase 1, anywhere between 20 million to 50 million is possible.
Right. That's interesting. So I'll move on to the next question. There is a question on what do you think of investments from a portfolio perspective? So we discussed volume-based diversification, but do you also look at industries or any other classification-based diversification when you're investing?
I have a strong point of view here. As an individual, and you know, I'm assuming most of us are in the age band of 40 to 70, right? So which means most of us will have 20 years of work experience. There's no harm in, out of your 50 to 100 startups, ensuring that at least 20 to 30% are in a sector or two that you are very, very familiar with and very comfortable. But don't do more than 20% in one sector or one space. Because you know there's like I said, you know now in the West there's this interesting author who talks about luck surface area, since a lot of things are, and I'm a big believer in not believer, but I like the writings of Nicholas Nassim Taleb. I think that's his full name. Fooled by randomness. So you know luck is going to play a role, and actually sometimes having too much knowledge of a sector may not necessarily improve your success percentage. I personally have found that in a sector where I know too much, I actually walk away from deals which have done well later, and I sometimes invest in deals which intellectually sound good but don't pan out so well. So I would say yes, ensure that 20% of your portfolio is in areas that you know a lot about. So this is the opposite of what I think many investors have said about listed equities, that invest in businesses that you know and understand. That's good for listed equities. I've not found it true for angel investments. I don't know why. I will apply my mind and try and figure out. But angel investments, I would advise you to let probability weigh in your favor, uh, rather than thinking you know which one will succeed and which one will not. I have been both unpleasantly surprised by the ones that failed and pleasantly surprised by the ones that succeeded.
I know that's a very interesting take, right? Because the first intuitive reaction for anybody would be to put in a larger, percentage into into sectors that you're more comfortable with. So I think that's a very interesting take you have on the way you do it.
No, but look, a startup succeeds against incumbents because it's doing something that the incumbents have not thought of. And if you're a sector person, you're the incumbent. So if a startup is going to succeed in your sector, they are going to do something that is going to sound quite wacky to you.
True.
So at least that's the simple explanation I've come up with. I over time, I guess I'll learn more, but that's the simple explanation I've come up with, and that's why I don't. Let's say you're a sort of great guy in data science and AI. Even then, I would suggest if you're an angel investor, don't do more than 20 to 30% of your startups in data science and AI. Spread it around.
Right. Of course. Diversification is always good in this asset class. Another related question to not exactly diversification, but I think more to do with time management. You mentioned early on when we started the conversation that you've invested over this time in almost 100 startups, right? And it's been like this constant, very, I think, consistent journey that one has to maintain an angel investment. So I think one of our participants has a question on that. I mean, in terms of how much time do you have to spend in tracking and evaluating these startups? Because eventually, once you invest in these startups, you also spend time in the post-investment stage of things. So how do you sort of balance that? And is there more emphasis on the evaluation and tracking side of things initially? I think that's one of the questions that's come up.
So here's one of the assumptions that, in my case, turned out to be not very true. I always assume that startups where I had a significant exposure, I would want to spend time and they would want to benefit from my inputs and advice. And for some reason, that's not so straightforward. Firstly, most startups have so much on their plate that they don't really want your inputs and advice on any regular basis. At least that's been my experience. I hope other people have a different experience, but they just don't want gyan regularly or pushing regularly. The startups which are quite enlightened and most likely to succeed know exactly what they want to use you for. And those are the ones I give access to. When they have a problem or when they have a question in my mind, they take time with me. The smartest amongst them actually send me context. And they take time with me for anything from 5 minutes to 1 hour. Recently, one of the startups pinged me and said they're getting an acquisition offer from a very large player who only has one element of their 5 or 6 offerings in their field. It was very quick. I said, are they offering you cash or a share swap? He said they've not specified. I said, when did they last raise capital? We Googled, we found that last raised capital of just 10 million, and it's a sort of unicorn. I said, if they last raised capital of just 10 million a few months ago, that's not going to last them more than a year, which means they're talking of a share swap. And within a conversation of 10 minutes, we were done that, look, if it's a share swap, it's a gamble because they're saying we are going for IPO. I said they're just bolstering their whole offering to try and get investors willing to put in more money and do a pre-IPO setup. I said, if you don't want to gamble with your startup, don't entertain any further things unless they're willing to make an all-cash offer. a literally 5-minute conversation on an evening. Equally, there's some startups who will ping me and say, we have a whole host of things. It's been 6 months since we spoke. Can you give us an hour this Saturday? And I'll actually set aside an hour, and they'll get, if there are sort of 4 co-founders, they'll be all 4. In fact, in that case, there are 5. They'll have all 5 co-founders, and that's a very interesting cybersecurity startup. They'll have all 5 co-founders. Each will have questions, perspective, and I'll share with them my perspectives. And then whether they go left, go right after hearing my perspectives, up to them. So being used as a sounding board actually doesn't take much time, and I found that much more useful. It's a good use of my time. And when the startup is reaching out to you, then you know that at least whatever you say to them is of relevance. So after investing in a startup, does it take up a lot of my time? No. On average, I would say, while my scanning and investment activities, I take around, let's say, 6 hours a week, mostly on weekends. My monitoring of startups, I would say, is less than 2 to 3 hours a week of giving them time on a weekend or evening whenever they want a quick chat.
I think that's a very interesting insight again, right? Because a lot of our attendees over here today are going to be starting their journey. A few of them, of course, are members already. But I think that is a good estimation for them to understand what the time commitment looks like, right? Both from an evaluation and a post-investment stage of things.
It's a hobby, and just like you would spend. So here's the thing. Just like you would spend 6 to 12 hours a week on a hobby that you were really passionate about, whether it's gardening or, I don't know, beetle collecting or something like that. If you would spend 6 to 12 hours a week on that, focused, this is that. And you can easily schedule most of it for the weekends.
So I have one question at this stage, Mr. Jamwal, for you. What could be the top 3 criteria for you when you're using to pick and evaluate startups? I mean, I know you threw some light on that, but if you had to just pick 3, which you would standardize across most sectors when you're having a first cursory look at these startups, what would those 3 criteria be?
Founder quality or founder caliber, without a doubt. And that covers a lot of ground. It means, are the founders passionate and committed? Are they of that domain, or do they have the right domain expertise, and do they have the right range of abilities that are needed to succeed? So getting a sense of the founders, to me, has always been very critical. Yes, in the desire to get to 50 to 100 startups, I'm not saying I have always looked at founders. For example, in IN, there are so many times I've invested just based on a what's that called, the announcement call, where for 1 hour you hear the founder's pitch. And so there, what you're doing is you're trusting that the other leads or the leads of that deal have looked closely at the founders. But wherever I've gone into something, I've tried to look closely into the founders and assess the founders. So to me, number 1 will always be the founders, because 80% of your bet is on the founders. In the best of the spaces, if the founders are bad, it's not going to work out. And the funny part is, in what appears to be a very average domain, if your founders are rock stars, you'll still, if not lose money, make a 5x, 3x or 5x return. So to me, number 1 and 2 and 3 out of 5 is founders. Then, of course, comes to what's the quality of the hypothesis that they have? How differentiated is it? Because many times, if you're lucky, you're actually seeing a product, but sometimes you're seeing a hypothesis of what the market is going to become and what their product or service is going to be. So item 4 would be, what is their hypothesis? What's the quality of the hypothesis and the strength? And item 5 definitely would be, and it's not that while I'm prioritizing these, it's not that you can get rid of any of them. Item 5 is, like I said, convexity, which depends on scale and disruptiveness of what. Item 4, which is the disruptiveness of their hypothesis or the product. And item 5, which is the scale of the market that they address. Because if you're if you're a great founding team and you have a very disruptive product, but there's no way that the market is going to be large, you're still not going to make 50x.
Right. No,
So if
that's
I was supposed to put three things, I would say founders, strength of hypothesis, and addressable market.
okay. Okay, great. Another question here on this is slightly different from what we were discussing about, but we could probably take this up about the term sheets, right? So, is negotiating term sheets really tricky, and what are the important terms? Or main part in identifying the right startup? I think this is going to be a longer response, but if you'd like to just sum it up in maybe 2 to 3 sentences. I've got
No, no, the
this
good
is
part,
going to be a longer one.
the good part about being part of a network, and thereafter, even in my direct investments, always asking that there be a VC or an institutional investor as part of that, is because fairly early in the game, when in one or two startups where it was direct and there was no institutional investor, the whole conversation of term sheets and terms and all took up so much of my time, I actually gave up on that line of approach altogether. So fortunately, because of going through angel networks like IAN, or insisting that if somebody comes to me direct, I will participate only if there's a institutional investor in the round and I'm tagging along on the institutional investor's term sheet, that has become a mantra for me. I don't have time. Like I said, it's a hobby, right? It's a deployment of capital and a hobby. I don't have time to negotiate term sheets or do DD or stuff like that. I just don't. So if that means that in some cases I may be missing out, maybe I'll get into things like that after my retirement or superannuation, or when I stop full-time work. Maybe I'll have the time and desire to negotiate term sheets, but at the moment I don't. And I think the IN system, where you have a very standard term sheet, which is given to every startup, and you actually resist any changes to that term sheet, is a very healthy thing. So somebody who wants to actually do it full time on their own, I would say standardize your templates and have those templates available, and just always use those templates.
Right. Well, that's
And
very
where you can fairly early in a conversation give the startup or the founder who's talking to you, give the startup founder a copy of your term sheet. Say, by the way, if we progress on our conversation, please understand that this will be the term sheet I'll be giving you, or this is the term sheet you'll be working on.
Mr. Jamwal, if I may just step in, Rajneesh here. So, the standardized template, right, we're talking about, that's what we need to defend, right? I think all of us spend considerable amount of energy, right, defending it, just making sure that there's a balancing act that is done between the investors and, of course, the heroes in the trenches, the founders, right? So there is a considerable amount of energy that goes into it. Yeah, thank you so much. Yeah.
But there's in some of the IN deals itself, I've seen that in some cases there's an education process that some founders have to undertake.
Yes.
And it's especially those founders who have never approached an institution. And when the first time they talk to IN, I remember the founding team arguing about good lever, bad lever,
True.
every single thing. They went through the whole term sheet and they wanted to argue about everything on the term sheet and understand the concept of that. So sometimes, unfortunately, and this is to all the angels out there, if you ever want to do this on your own and full time, there will be times you'll have to begin to educate a person about what outside investment means.
Yeah.
I think we have the last 5 minutes left. So I'm going to just quickly take up the next 2, 3 questions that we have. So the interesting one, I think we've not spoken about this one as yet. What are the red flags that you would watch out for when you're evaluating?
Founder motivations. When I'm evaluating networks or
no, when you're evaluating a pitch.
No, I'll tell you both. So
Both.
first, networks, I will again emphasize. Make sure you're not part of a network where the entire motivation of that network, or that, what's it called on Angel List and Let's Venture, there are these things called what? Consortium. No.
The
syndicate. Just make sure that the motivations of that syndicate or network is not to sell the largest number of deals for the largest deal size. If that's the motivation, then you're being hard sold, not quality but quantity. So yeah, so motivations of networks is important. Motivations of founders is important. Yes, of course, the founders should want to make money, but if their motivations and their values are not in the right zone, which is a balance between wanting to make money versus doing anything to make money. If their valuation and their value systems and motivations are not in the right zone, and there are many places you can get a sense of such things. For example, offering different people different deals, offering side deals, offering, there are many small things that can show what the value system of the founders are. If the value system of the founder is off, it'll come back and bite you at some stage. If the startup makes money, the founder will find a way to make sure you make less money than he makes. If the startup doesn't make money or is struggling, you will be jettisoned very quickly, or the founder will walk. So, values, value systems, motivations, again, of the founders.
Right. And I think we spoke about evaluations of course, the initial rounds, right? The first rounds when we put in our first check. But how do you sort of evaluate whether or not you'd like to invest in the next rounds, or how are you evaluating the companies for the follow-on rounds? Of course, as a lead investor, as a mentor, you'd be more closely associated with the company. But given a situation where you're probably not, in that role of a mentor for a company, how do you evaluate as an investor whether you'd like to reinvest in the company on a follow-on?
No, I'm very bad at that. In most companies where I've invested in follow-ons, especially if they've been follow-ons out of desperation and not performance, it's not turned out well. I should mention that an additional useful funnel for me has been, because when I entered into angel investing, I also said, let me keep a benchmark of what a third party can do with my money. So I also became an LP in some VC funds. And those VC funds give you those follow-on investments, which naturally are at a slightly later stage. But because they're at a slightly later stage, they're a little safer. I think that's a different pool of capital. Ideally, most of your 50 investments, 50 angel investments should be of roughly the same size. I've been very indisciplined in that respect, and I think that has not served me well. I would say it served me well if wherever I put in a larger check, the outcomes were better, or wherever I put in 2 checks instead of 1, the outcomes were better. No, actually, the original math that I was told, if I had followed that, I think I would have been relatively better. I'm not badly off, but I would have been relatively better. Which again goes to show that, I mean, you talk to any VC, Smriti, and you tell them that, look, at the point of entry in your 35 or 40 investments that you're going to make, do you know which ones are going to succeed? The honest VC who's on his 3rd or 4th or 5th fund will say no. I don't know which one is going to give me 1x the fund or be a fund returner. He just doesn't know. And he's a smart guy who's on his 3rd or 4th fund. He'll still say, I can never predict which one will be the fund returner.
Right. Absolutely.
So ideally, you should do follow-on investments from a different pool of capital, because that's a different risk-reward framework.
Right. Right. I think we are just left with 2 minutes now. So would you like to take another last one or?
Last one.
Okay.
Exactly
Last
2
one.
minutes.
So I think there are a couple of questions. I'll just probably spin them together. I think a lot of people want to know from you, how do you decide to exit? Like what's the right time to exit from an investment?
My suggestion would be, if you're not a fund and if you don't need money, exit at IPO. If the startup is doing well, if the startup is failing and you're being forced to exit, so I'm leaving aside the forced exits, I'm leaving aside the failures. If the startup is doing well and growing, exit at IPO. My first IN investment, within 6 months, an offer came to buy out at 3x.
Oh, wow.
And some of the more seasoned investors were actually complaining that how can I bring us this offer? So I said, what's your problem? In 6 months, you're making 3x. They said, Jamwal, don't you realize that if it's 3x in 6 months, this is the most likely to be 50x? And I, of course, being a finance man, I said, 3x in 6 months is a fantastic IRR and all that. 3 or 4 years later, they gave us an exit at 31x. So, actually, I tendered half my shares at 3x, thinking that the IRR is too compelling. But the reality is, if I had retained it, I would have got the entirety at 31x. So, a startup that's doing well, why not write it to IPO until you're forced to exit by a VC who says, I want to buy out all the bits and pieces? Because look, you are out of your 100, you are only going to get 5 which are fund returns. If you kill those 5 early, you're not going to get the best outcome. So I hope I have the courage to follow my advice. I'm trying to make sure I do.
No, very true, Mr. Jamwal.
It takes courage, yes. Intuition says grab what you can and run.
So, okay, I think we'll wrap up with the questions with this. I think for all the other questions on the audience, so we will try to take them up at a later stage. But I think for now, we'll need to wrap this up. And just as a last note, I would really like to express our gratitude to you, Mr. Jamwal, for joining us on the session today. And I think I personally had, I'm sure the audience too did, but very valuable insights, and we learned a lot from your journey. So
If it helps other people have a useful and productive and fruitful investment journey, I'll be very happy. Thank you, Steve. Thank you, Rajneesh. Thank you.
Thank you so much, Mr. Jamwal. Really appreciate it.
Thank you so much, Mr.
Thank you,
Jamwal.
everyone. Yeah, for
Thank
joining.
you so much, audience, for joining us today and taking the time out.
Thank you, everyone.
Thank you. Thank you, everyone.
Bye.
Bye-bye.